It's important to discuss banking system in India. Bank of Hindustan 7070, it means 1770, was the first bank to be established in India. Alexander and Company established it at Kolkata under European management. Other banks set up were Bank of Calcutta, renamed as Bank of Bengal 1806, then Bank of Bombay and Bank of Madras. These were called presidency banks. These worked as quasi central banks for many years. The present State Bank of India was formed by merger of these three banks, presidency banks like Bank of Bombay, Bank of Madras, and Bank of Bengal. Thus, SBI is considered the oldest functional bank of India. First bank with limited liabilities managed by an Indian board was Awadh Commercial Bank, founded in 1881 at Faizabad. At first, purely Indian bank was the Punjab National Bank, 1894, at Lahore. Reserve Bank of India, headquartered in Mumbai, it is the central bank of the country. It was established on April 1, 1935, with the capital of 5 crore. This capital of 5 crore was divided into 5 lakh equity shares of 100 each. It was nationalized in January 1, 1949, as government acquired the private shareholdings. Administration 14 directors in central boards and many of their governors. First governor of RBI was Sir Smith. Okay, what are the main functions of RBI? It is really important for issue of notes. Okay, the Reserve Bank has adopted the minimum reserve system for the issue of notes. Since 1957, it maintains gold and foreign exchange reserves of 200 crore, of which at least 115 crore should be in the gold. Banker of the government acts as a banker, agent and advisor of the government of India. Okay, and it also managed the public sector of the for the government. Bankers Bank, the Reserve Bank, perform the same function for other banks as the other banks ordinarily perform for their customers. Then controller of credit, the Reserve Bank undertakes the responsibility to control the credits in India. Then custodian of foreign reserves, for the purpose of keeping the foreign exchange rates stable, the RBI buys and sells the foreign currencies and also protects the country's foreign exchange funds. Then it formulates and administers the monetary policy, act as the agent of government of Indian in respect of India's membership of the IMF and World Bank. No personal accounts are maintained and operated in RBI. Now it's time to understand Imperial Bank of India. It was created in January 1921 by amalgamation of three presidency banks: Bank of Bengal, Bank of Bombay, Bank of Madras. After nationalization in 1955, its name was changed to State Bank of India. State Bank of India started in, uh, I have already told about it. Then what are the main functions? You can say State Bank of Bikaner and Jaipur. Many of banks are there. It's subsidiary banks are there. The State Bank of India uses the blue keyhole logo. Okay, then nationalization of the banks in order to have more control over the banks. 14 large commercial banks, the reserves of which were more than 50 crore each, were nationalized on July 19, 1969. The RBI Act of 1934 has classified the commercial banks as scheduled banks and non-scheduled banks. The scheduled banks are those which have a paid up capital and reserves of an aggregate value of not less than rupees 5 lakh, and which satisfy RBI that their affairs are carried out in the interests of their depositors. These banks have been entered in the second schedule of the RBI Act 1934. Okay, then after regional rural banks set up in 1975, their main objective is to develop the rural economy by providing credits and encouraging other productive activities in the rural areas. On October 2, 1975, initially 5 RRBs were established at Moradabad and Gorakhpur in UP, then Bhiwani in Haryana, Jaipur, Rajasthan, and Malda in West Bengal. Later on, RRBs were extended to other districts of the country. The first RRB was Prathma Bank, headquartered in Moradabad, sponsored by Syndicate Bank. Difference between authorized capital and paid up capital. To understand this, let's take an example of a glass filled with water. Authorized capital is like the glass that holds the water. It is the maximum number of the shares a company can issue. To increase authorized capital, shareholders approval and payment of the fees to the government of India is required. Paid up capital is like water in the glass. It is the number of the shares the company has issued to its shareholders. The company has the capacity to issue more shares up to the authorized capital of the company. Other financial institutions, when we talk about Small Industries Development Bank of India, it means SIDBI, established in 1990 and promotes a small scale sector. Then National Bank of Agriculture and Rural Development, it means NABARD, established on November 5, 1982. Its refinance is available to state cooperatives, agriculture and rural development banks, state cooperative banks, regional rural banks, commercial banks and other financial institutions approved by RBI. Export Import Bank of India, EXIM, set up on January 1, 1982, grants deferred credit to Indian exporters in order to operate in the international markets. Then NHB, National Housing Bank, was established in July 1988 as wholly owned subsidiary of RBI. Industrial Development Bank of India, now IDB Bank. Okay, the IDB was established as Development Financial Institution under IDB Act 1964, was converted as a banking company in 2004. Industrial Credit and Investment Corporation of India Bank, now ICICI Bank, established in 1955 as a public a limited company to encourage and assist industrial units of the nation. It has been converted into private sector bank with effect from May 3, 2002. Okay, then payment banks. When we talk about a payment bank, is a differentiated bank in which customers can open a saving account with deposit of up to rupees 1 lakh. However, these banks cannot lend money to their customers. It is the new model of banking launched on the recommendation of Nachket More Committee recommended payment banks. Now, Basel banking norms, it's really important. Basel is a city in Switzerland, which is also the headquarter of Bank for International Settlements, yani BIS, an organization of central banks. BIS, established May 17, 1930, is the world's oldest international financial organization. BIS fosters cooperation among central banks with a common goal of financial stability and common standards of banking regulations. Currently, there are 60 members of this institution. Basel guidelines refers to broad supervisory standards formulated by this group of central banks called the Basel Committee on Banking Supervision, BCBs. Okay, so Basel 1, Basel 2, Basel 3 are some guidelines there. So if we talk about the Reserve Bank of India on May 2, 2012 published guidelines for implemented of Basel 3 by March 2019. What is Basel 3? In 2010, Basel 3 guidelines were released. These guidelines were introduced in response of financial crisis of 2008. A need was felt to further strengthen the system of banking in the development economies were undercapitalized, leveraged and had a greater reliance on short-term funding. Also, the equality and quantity of capital under Basel second were deemed insufficient to contain any further risk. So this much is all about. So here we are going to talk about quantitative and qualitative credit control measures. Okay, so quantitative credit controls, when we talk about, so many of measures are there. When we talk about important points related to this, so very first, bank rate, also known as discount rate. It is the rate at which the RBI extends credit to commercial banks. If the RBI wants to increase the liquidity and money supply in the market, it will decrease the bank bank rate, and if it want to reduce the liquidity and money supply in the system, it will increase the bank rate. The marginal cost of funds based lending rate, MCLR, refers to the minimum interest rate of the banks below which it cannot lend, except in some cases allowed by the RBI. It is an international benchmark or reference rate for the bank. MCLR actually describes the method by which the minimum interest rate for loans is determined by a bank on the basis of marginal cost for or the additional or incremental cost of arranging the one more rupee to the prospective lender. Okay, then cash reserve ratio, CRR. A commercial bank is required to keep a certain percentage of its total deposits with the RBI in cash. RBI does not pay any interest on this amount. It is called as cash reserve ratio. RBI uses CRR to increase or decrease the reserve requirement depending on the whether it wants to affect or decrease, or it increase in the money supply. Then, when we talk about SLR, statutory liquidity ratio, it is that ratio percentage of its total deposits which commercial banks has to maintain with itself. Apart from CRR, banks are required to maintain liquid assets in the form of gold, cash, or approved securities. Higher liquidity ratio forces commercial banks to maintain a larger proportion of their resources in liquid form, and thus reduces their capacity to grant loans and advances. Thus, it is an anti-inflammatory impact. Now we talk about LAF, liquidity adjustment facility. LAF is a facility extended by the RBI to the scheduled banks, excluding RRBs and primary dealers, to avail of liquidity in case of requirements or park excess funds with the RBI in case of excess liquidity on the overnight basis. LAF is an important tool of monetary policy and enables RBI to transmit interest rate signals to the market. Repo rate, repo means repurchase. Okay, so repo means repurchase. Repo rate is the rate at which the RBI lends short term money to the banks in against securities. When the repo rate increases, borrowing from RBI becomes more expensive. In case RBI wants to make it more expensive for the banks to borrow money, it increases the repo rate. Similarly, if it wants to make cheaper for banks to borrow money, it reduces the repo rate. Now, reverse repo rate, the rate at which banks deposit their surplus short-term funds with RBI against security. The banks use this tool when they feel that they are stuck in with their excess funds and are not able to invest in anywhere for reasonable returns. An increase in the reverse repo rate means that the RBI is ready to borrow money from the banks at a higher rate of interest. Now we will come to marginal standing facility. It means MSF, started in 2011. It refers to the rate at which the scheduled banks can borrow funds overnight for one day. Okay, from RBI against government securities. MSF is a very short term borrowing scheme. No need to maintain SLR in this loan. Open market operation, it means OMOs are the market operations conducted by the RBI by way of sale purchase of government securities to form the market with an objective to adjust the rupee liquidity conditions in the market on durable basis. When the RBI feels there is an excess liquidity in the market, it restored to sale of securities, thereby sucking out the rupee liquidity. Similarly, when the liquidity conditions are tight, the RBI will buy securities from the market, thereby releasing liquidity into the market. Government securities of you can say GSECs are instrument issued by government to borrow money from the market. They are also known as gilt-edged securities. So it's really important. Government securities you can also called as gilt-edged securities. The term gilt-edged means of the best quality. Okay, it has come to be reserved for government securities as they do not suffer from the risk of default. Government security means a security created and issued by the government mainly for the purpose of raising a public loan. Let's come to understand treasury bill or T bills. Short term government securities are treasury bills. Treasury bills, it means T bills. They have a maturity of less than 1 year. There are three main treasury bills in India: 91 day, 182 day, and 364 day. Okay, then RBI conducts auctions usually every Wednesday to issue T bills. Long term government securities are known as government bonds or dated securities. They have a maturity period of 5 years, 10 years, and 15 years. Now we are going to talk about negotiable instruments. There are certain documents used for payments and business transactions and transferred freely from one person to another. Such documents are called as negotiable instruments, such as bill of exchange, promissory notes, check. So, negotiable instruments is a transferable document where negotiable means transferable or instrument means documents. According to the Negotiable Instruments Act in 1881, there are three types of negotiable instruments. These are promissory note, bills of exchange, and checks. Okay, so we will deal with one by one. Very first, promissory notes. A promissory note is an instrument in writing, not being a banknote or a currency note, containing an unconditional undertaking signed by the market to pay a certain sum of money to or to the order of a certain person. Suppose you take a loan of rupees 5,000 from any your friend X. You can make a document stating that you will pay the money to X or the bearer on demand, or you can mention in the document that you would like to pay the amount after 3 months. This document, once signed by you, duly stamped and handed over to X, becomes a negotiable instrument. Now X can personally present in it before you for payment or give this document to some other person to collect money on his behalf. He can endorse it in somebody's else name, who in turn can endorse it further till the final payment is made by you to whosoever present it before you. This type of a document is called a promissory notes. It you can say it is like a promise, okay, that you are going to return this type of amount. Endorsement means transfer of any document or instrument or to another person by signing on back its back or face or on a slip of paper attached to it. Then bills of exchange. So second one is bills of exchange. I have told you na three types of negotiable instruments. First one promissory note, second one bills of exchange. So a bill of exchange is an instrument in writing containing an unconditional order signed by the signed by the maker, directing a certain person to pay a certain sum of money only to or the order of a certain person to bearer to of the instruments. Bank drafts or demand draft is a bill of exchange where the payment is guaranteed to be available by the issuing bank. Typically, banks will review the bank drafts requester's account to see if sufficient funds are available for the check to clear. Bank drafts are generally used when you need to pay somebody with guaranteed funds. The term cashier's check is sometimes used instead of bank drafts. If you write a personal check, your check may bounce. However, banks only issue bank drafts after they have taken money from your account. So this is all about in bills of exchange. You can say, in short, you can say it is a demand draft. Okay. Now the third one is a check. Check is an instrument in writing containing an unconditional order addressed to a banker, signed by the person who has deposit money in this bank with the banker, requiring requiring him to pay on demand a certain sum of money only to or to the order of certain person or to the bearer of instruments. Check are mainly four types: open check, bearer check, order check, and cross checked. So a check is called open when it is possible to get cash over the counter at the bank. Bearer check, a check which is payable to any person who present it for payment at the bank counter is called a bearer check. Then order check, it is one which is payable to a particular person. In such a check, the word bearer may be cut out or cancelled, and the word order may be written. Okay, so the word bearer should be cancelled and order should be written there. So that is called as order check. And cross checked, when a check is crossed, the holder cannot in cash it at the counter of the bank. The payment of the such check is only credit to the bank account of the payee. Banks also offer the following checks which guarantees payments like self check, post dated check, PDC, and banks check, and the fourth one, travelers check. RBI since 1 April 2012 has brought down the validity of checks, drafts, pay orders, and banks check to 3 months from the previous 6 months. So the timing period of these checks like demand drafts and checks are now 3 months only. Bank deposits we are going to talk about. One thing I want to add it that I have told you that the measures of credit control can be divided into two types: quantitative credit control and qualitative credit control. So here I want to tell you that for quantitative credit control, the central bank takes the help of bank rate, open market operations, it means OMOs, then statutory liquidity ratio, it means SLR, and cash reserve ratio. Whereas, so these are, and it means CRR, SLR, bank rate operations, open market operations, and bank rate. These four are used as quantitative credit control measures, and some others are like publicity, rationing of credit, regulation of customer credit, moral suasion, then variation in margin requirements are the qualitative credit control methods. Now we will move forward about bank deposits. One of the most important functions of any commercial bank is to accept deposits from the public, basically for the purpose of lending. Deposits from the public are principal sources of the funds of for bank. So here we have four types: current bank account, saving bank account, fixed deposit account, and recurring deposit account. So we will deal with one by one. Current bank account. Current bank account is opened by businessmen who have a higher number of regular transactions with the bank. It includes deposits, withdrawals, and contra transactions. It is also known as demand deposit account. In such accounts, amount can be deposited and withdrawn at any time without giving any notice. And a current account holder gets a one important advantage of overdraft facility. That is really important. When anyone have current account facility, it can overdraft facility it has. Then saving bank account. Saving accounts are open to encourage the people to save money and collect their savings. The saving account holder is allowed to withdraw money from the account as and when required. The interest which is given on saving account is sometimes attractive but often nominal. Okay, then fixed deposit account. The account which is opened for a particular fixed time by depositing particular amount is known as fixed term deposit account. The term fixed deposit means that the deposit is fixed and is repayable only after the specific period is over. Okay, the rate of interest paid for fixed deposit varies, changes according to amount, period, and from the bank to bank. Recurring bank deposits. In recurring bank deposits, a certain fixed amount is accepted every month for a specific period, and the total amount is repaid with interest at the end of the particular fixed period. Recurring deposits accounts is opened by those who want to save regularly for a certain period of time and earn a higher interest rate. The most important function of the bank is to accept deposits from the public. Such deposits may be following types: demand deposits, time deposits, net demand, and time liability. So I'm going to deal with one by one. Demand deposits which can be withdrawn on demand are called demand deposit, include current deposits and saving deposits. And time deposits which can be withdrawn after the expiry of a fixed time period, the call it is called as time deposits, include fixed deposits and recurring deposits. Interest paid by banks is highest for the fixed deposits and lowest for current deposit. Okay, net demand and time liability is the sum of demand and time liabilities of banks. And NDTL is calculated and reported every fortnight Friday by banks. NDTL, it means net demand time liabilities, is used by banks for computation of CRR, SLR, and now LAF. Time deposit contributes to around 90% and demand deposit contributes around 10% of aggregate deposits for the all scheduled banks. Non-performing assets, or you can say NPAs. An asset of banks such as loan given by banks turns into a non-performing asset, NPA, when it ceases to generate regular income such as interest rate or interest for the bank. In other words, when a bank which lends a loan does not get back its principal and its interest on time, minimum 90 days, the loan is said to have turned into an NPA. While NPAs are a natural fallout of undertaking banking business and hence cannot be completely avoided, high levels of NPAs can severely erode the bank's profit, its capital, and ultimately its ability to lend further funds to potential borrowers. India has three main electronic funds settlement systems for one transaction, one to one transactions, like real time gross settlement, RTGS, national electronic fund transfer, it means NEFT, and immediate payment service, it means IMPS. Okay, so these are really very important. Let's try to understand one by one. RTGS. RTGS system is a fund transfer mechanism. While transfer of money takes place from one bank to another on a real time or on gross basis. This is the fastest possible money transfer system through the banking channel. RTGS is large value, minimum value of transaction should be 2 lakh. Funds transfer system. Okay, now it's a national electronic funds transfer, it means NEFT system is a nationwide system that facilitates individual firms and corporates to electronically transfer funds from any bank branch to an individual firm or corporates. For being part of NEFT funds transfer network, a bank branch has to be NEFT enabled. Core banking enabled banks are and branches are assigned an Indian Financial System Code, IFSC, for RTGS and NEFT purpose. So what is IFSC code? It means Indian Financial System Code. This is an 11 digit alphanumeric code. What is IFSC? Okay, so it is an 11 digit alphanumeric code and unique to each branch of bank. The first four letters indicate the identity of the bank and remaining seven numerals indicate a single branch. This code is provided on the checkbooks which are required for transactions along with recipient's account number. Difference between RTGS and NEFT we are going to talk about. While RTGS is based on gross settlement, NEFT is based on net settlement. Gross settlement is where a transaction is completed on one-to-one basis without bunching with other transactions. As for the deferred net basis or net settlement, transactions are completed in batches at a specific time. Here all transfers will be held up until a specific time. RTGS transactions are processed throughout the working hours of the system. RTGS transactions involve a large amount of cash, basically one funds above 2 lakh can be transferred transferring using this system. For NEFT, there is no limit, either minimum or maximum, on the amount of funds that could be transferred. So RTGS, we have some amount to limit, but NEFT don't have any limit. Then immediate payment service, it means IMPS. It is an instant real time interbank electronic funds transfer system, which offer an interbank electronic fund transfer service through mobile phones. Unlike NEFT and RTGS, the service is available 24/7 throughout the year, including bank holidays. All it needs is the account number and mobile number of the participants. Launched on November 2010, it is managed by National Payments Corporation of India, NPCI. So it's really important that NPCI, it means National Payments Corporation of India, launched it. Okay, IMPS, Unified Payment Interface. It means UPI. UPI is an instant real-time payment system developed by National Payments Corporation of India. It means NPCI. Facilitating interbanking transactions. It is regulated by RBI. UPI withdraws and deposit funds directly from the bank account whenever a transaction is requested. What are the main requirements for a UPI? Bank account, mobile number which is linked with bank account, a smartphone, and internet facility, debit card, or resetting MPIN. Now I'm going to give you a simple two lines explanation of some terms, like bank run. What is means of bank run? Bank run occurs when a large number of customers of a bank withdraw their deposit simultaneously due to concerns about the bank's solvency. Okay, then MICR. MICR is an abbreviation for magnetic ink character recognition. MICR code is a 9-digit code which is printed at the bottom of a check. Okay, then this code is unique to each bank branch. A white label ATM is a automated teller machine operated by non-banking companies. Any non-bank entity with a minimum net worth of rupees 100 crore can apply for white label ATMs, not just NBFCs. Any non-bank entity can apply. A sponsor bank loads the cash in these ATMs. This also ensures counterfeit fake currency notes are not circulated through white label ATMs. Customers of any bank can use such white label ATMs, but they have to pay fees for using the services. Then parabanking are the activities which are done by the bank apart from its normal day-to-day activities, like deposit withdrawal, are called parabanking activities. Example, insurance business, pension fund management by banks. Investment banking is a special segment of banking operation that helps individual or organization raise capital and provide financial consultancy services to them. Underwriting is one of the most important functions in the financial world, wherein an individual or an institution undertakes the risk associated with a venture, an investment, or a loan in lieu of a premium. Ponzi scheme is an investment plan in which the company pays returns to investor from the new capital coming in from new investors instead of the profits of the business. Further related topic I will cover in the next audio. Thank you.